All right, let's talk about something that drives every trader crazy. I mean, that feeling when it seems like the market just has it out for you personally.
You know exactly what I'm talking about, right? You do your research, you place a trade, you set a smart stop loss, and then bam, the price just nicks your stop, takes you out of the trade, and then almost to the second, it reverses and rockets in the exact direction you predicted. It is maddening. But what if I told you it's not bad luck?
That's right. There is a hidden game being played, a deliberate hunt that happens on the charts every single day. And if you can understand this game, you can go from being the one who's hunted to being the hunter. And the secret? Well, it all comes down to one word: liquidity.
So, what is this big important concept, liquidity? It sounds technical, I know, but the idea is actually super simple, and it's the engine behind almost every major move you see in the market.
All liquidity really means is how many buyers and sellers are ready to trade at the current price. In a super liquid market, there are tons of orders on both sides. You can buy, you can sell, and you get the price you see on the screen. But in a market with low liquidity, well, that's where things get tricky.
To make this totally clear, let's just step away from the charts for a second. Let's think about something simple, like trying to buy a whole bunch of brand new iPhones.
So look at it this way. If you walk into a store that has 1,000 iPhones in the back, that's a high liquidity situation. You can easily buy your 100 phones at the sticker price. No sweat. But what if the store only has 50 in stock and you absolutely need 100? Well, you're going to have to pay a little extra, a premium, to get those other 50 phones. That extra cost is what we call slippage in trading. And this happens all the time in the financial markets, just with millions and millions of dollars.
Okay, so that brings us to the big fish, the giant banks, the hedge funds, the major institutions. They have a huge liquidity problem. And the way they solve it, well, it sets up this David versus Goliath situation where, unfortunately, we retail traders are usually David, but we forgot our slingshot at home.
Just try to imagine you're a massive fund, and you need to sell, say, $500 million worth of some stock. You can't just log in and smash the sell button. There's simply not enough buy orders at the current price to absorb a sale that big. If you tried, the price would absolutely tank, and you'd end up selling most of your shares for way less than you wanted. It's a huge problem for them.
So to get around this, these institutions have to be clever. They need to find a giant concentrated pool of orders going in the opposite direction. So if they want to sell big, they have to find a place where a ton of people have placed buy orders. And wouldn't you know it, retail traders leave these little clusters of orders all over the charts in very, very predictable places. And here it is. This is the big aha moment. You know that stop loss order you placed to protect yourself from a big loss? That is the exact pool of liquidity these institutions are hunting for. Your protection is their opportunity. It's the fuel they need to fill their enormous trades. Let's just be really clear about what a stop loss actually is. If you buy a stock, your stop loss is a dormant sell order waiting below the price. And if you are shorting a stock, your stop loss is a dormant buy order sitting above the price. The big institutions know this, and they know exactly where we all tend to cluster these orders, right below support or right above resistance. So, this whole process, this institutional tactic, it has a name. It's often called a liquidity sweep or a stop hunt. And this move, this is the fake out that has probably made you want to throw your computer out the window more than once. This is its signature look. The price will push just a little bit past a super obvious support or resistance level, just far enough to trigger all the stops hiding there, and then it aggressively snaps back in the other direction. It's a trap. So let's run through the anatomy of this trap. Imagine the price is moving up to a really clear resistance level that everyone can see. As it breaks through, two things happen at once. First, all the traders who are shorting have their buy stops triggered. That's a huge wave of forced buying. Second, all the eager breakout traders jump in, thinking it's heading to the moon. That's even more buying. Now, the institutions who wanted to sell big all along suddenly have this massive flood of buy orders to sell into at a fantastic price. They dump their shares, the buying pressure instantly disappears, and the price just collapses. Trap sprung. Okay, so that's the trap. Now for the good part. How do we spot this happening? And even better, how do we use it to our own advantage? The great news is, once you know what you're looking for, it's a pattern that sticks out like a sore thumb. And you don't have to glue your eyes to the screen all day. This pattern shows up most clearly on the shorter time frames. Think the 5-minute or the 15-minute chart. That's where these pools of retail stop losses really tend to build up and become obvious targets.
So here's the simple 3-step recipe. First, you find a super obvious level on your chart, one that has been tested multiple times. Step 2, you wait and watch for the price to poke right through it. That's the grab. And then step 3, this is the most critical piece. You look for a powerful rejection. You want to see a big candle close firmly back inside the previous range, often leaving behind a long, nasty-looking wick. That wick is the footprint. It's the clue that institutions were just there.
So, the whole point of learning this isn't just to stay out of trouble. The point is to actually turn these traps into some of the best trading opportunities you can find. Once you can spot this pattern, you gain a massive edge. Think about it. When you enter after the sweep has happened, you're jumping into a move that has huge momentum behind it. Your risk is tiny and well-defined. You can just place your stop on the other side of that wick. And your potential reward? It's huge. But most importantly, you're no longer the one getting trapped. You're trading in the exact same direction as the smart money that just engineered the entire move.
And this really gets to the heart of the mindset shift. The average trader, the bait, sees that price break a level and they react. They either get stopped out of their old position or they chase the new breakout. The informed trader, the hunter, sees the exact same price action and thinks, aha, a liquidity sweep. They wait patiently for the trap to be confirmed, and then they enter. They turn someone else's loss into a high probability win.
So the next time you're on a chart and you see the price spike through a key level and then violently reverse, you won't be confused. You'll know exactly what's going on. You're watching a hunt in real time. And now the only question is, are you going to be the bait or are you going to be the hunter?